So now we turn our attention back to the efficient market hypothesis, and we need to reevaluate what we've learned about that. If we accept the efficient market hypothesis, then there is no chance of any investor outperforming the market consistently over time. But we only need to look at the investment records of people like John Maynard Keynes, who ran the King's College Chess Fund, Benjamin Graham, Warren Buffett, Charlie Munger, Michael Lynch, who ran the Magellan Fund, and Bill Ruane, who ran the Sequoia Fund, to see that this is not the case. However, we have seen that investors are not rational, and recent behavioural finance studies have shown this is rarely the case. Charlie Munger has over 20 different explanations for why people make poor investment decisions. Simplifying assumptions, remember, often help to make a theory easier to explain at the cost of detaching that same theory from reality. Investors do not process information correctly. They frequently rely on shortcuts to determine stock prices and make investment decisions. Very few investors rely on fundamental analysis and an investigation into the economic characteristics of businesses. Performance measurement relies on short-term yardsticks, such as quarterly performance based on share prices, which makes it all but impossible to beat the market over a long period of time. This also encourages high levels of trading, which incurs costs and taxes, as well as encouraging investors to sell into falling markets and to buy into rising markets, when the exact opposite strategy makes more logical sense. Buffett's fundamental issue with the efficient market hypothesis is that it makes no provision for analytical investors who take the trouble to do their homework. While he accepts that the market is frequently efficient, he holds that it is never 100% efficient all of the time. And of course, you can't gauge share prices to understand whether or not the market is being efficient, because we've seen they fluctuate irrationally. The key point behind his approach is that he is able to take advantage by doing his analysis and his fundamental understanding of business economics. He's able to take advantage of Mr. Market's exuberance and depression at his wish, not following Mr. Market's guidance. So if modern portfolio theory, risk diversification and price and market efficiency do not provide us with the tools to value companies and make investment decisions, we need to identify a strategy that does. And this we will take a look at in the next lecture. So it's very dangerous to just follow the market, to accept modern portfolio theory and the efficient market hypothesis in particular, and just follow the crowd. You need to do your own thinking, and to do that you need to go back to the basics of fundamental analysis of businesses rather than just watching the lottery of share prices.